Welcome back, everyone. Welcome to the program. If you're new, thank you so much for joining us. I'm so glad you're here. Please make sure that you are subscribed to World Affairs in Context on Substack or Patreon for more and exclusive content. Follow the links in the video description below to get connected. By the way, I just uploaded a brand new post on those two platforms about President Trump's recent announcement. He just declared national emergency related to Cuba. This is a very, very interesting topic. And in that new post, I discuss the Russia and China factor within this new escalation. So I think you should definitely check it out. And it is a free post. So you're welcome to read it and share it. For months now, we have been told a very simple story. The tariffs are back and America is therefore finally getting tough. The trade deficit is being crushed, factories are coming home, and the trade imbalance is being fixed. Well, the problem here is that a trade deficit is not the issue. It's simply not a problem for a country to have a trade deficit. And in this video, I will explain why the latest headlines are meant to deceive you, to distract you, to misinform you. The information I'm about to share with you today will help you understand one of the most important economic indicators, and I will probably write more on this over on my Substack or Patreon to dive deeper into this topic. It is just a very, very important one. First, let's quickly run through the recent numbers officially available as of today. So for comparison purposes, in October, the U.S. trade deficit sat at just over $29 billion, which is the lowest level since early 2009. That was held up as proof that the tariff regime was working. But 1 month later, in November, the deficit didn't just rise, it nearly doubled, exploding to almost $57 billion. That is a 94% jump in a single month. A 94% jump in 31 days. And economists were not even expecting that. They weren't even close. Forecasts were blown out of the water. Exports fell by nearly 4% and imports surged by 5%. The gap widened fast, and it widened most sharply with America's largest trading partner, the European Union. The U.S. goods deficit with the EU jumped from under $8 billion in October to roughly $14 billion in November. About 1/3 of the entire surge in the trade deficit came from Europe alone. This is happening despite, and more accurately because of, the tariff agenda, as well as the US-EU escalations. And that's where the story gets really, really interesting. A trade deficit is not an economic failure. It does not mean that the US economy is collapsing. It simply doesn't mean that. And it's not proof that a country is being quote-unquote ripped off, which is what President Trump loves to say. And it's not by itself evidence of economic weakness. That framing is completely wrong. A trade deficit simply means that the United States imports more goods and more services than it exports. That's it. It does not mean America is losing money the way a household would in this scenario. Countries are not households. They don't settle trade accounts with a credit card bill at the end of the month. So when you look at these month-over-month fluctuations, don't get distracted. Don't over-dramatize the numbers. What actually matters is what we're importing, what we're exporting, and what happens, attention, what happens to the dollars that flow abroad. In other words, capital flows matter more than a deficit or a surplus reading at any given point in time. Here's the main takeaway that I would like you to remember from this video. When the United States runs a trade deficit, foreigners don't take those dollars and bury them somewhere in the ground. They recycle back into the American financial system. Those dollars get recycled back into the American financial system. That is how the entire world actually supports the US economy. And it has been going on for decades. They buy US treasuries, they invest in stocks, they purchase real estate, they fund companies, they fund their expansion, and they provide capital. And so the trade deficit is the mirror image of a capital surplus. Those capital inflows help keep U.S. interest rates lower than they would otherwise be. They finance government borrowing. They support asset prices. They fund innovation and expansion, as I mentioned earlier. And that is not a bug of the system by any stretch of imagination. It's how the system is designed to work. There's also the reserve currency reality that almost no one wants to talk about honestly. The world runs on US dollars. Global trade, energy markets, debt markets, and financial plumbing, all of those things require a steady supply of dollar liquidity. And here you would ask me, but you're always talking about de-dollarization. Yes, the US dollar is slowly but surely losing its global dominant status. But as of now, it's still the reserve currency of the world. That's a fact. Currency multipolarity has been accelerating. Why? Because Washington weaponizes its currency, but the dollar is still in demand. That's just a fact. And what's important to remember is that the only way the rest of the world can get those dollars is if the United States runs persistent deficits. If the United States suddenly, quote unquote, balances trade, global liquidity would shrink, financial stress would rise, capital markets would tighten, and that would not be a victory by any stretch of imagination. It would be a shock, and nobody can afford that kind of shock right now. In other words, trade deficits are a symptom, not a verdict. They reflect high domestic consumption, they reflect strong demand, and they reflect a currency the world still wants to hold and an economy that attracts capital. None of that means that there are no downsides, of course. Certain industries do lose out. Workers in those exposed sectors and those exposed industries bear real costs. Supply chain dependence creates vulnerabilities, of course. So these are legitimate concerns. But trying to fix all of that with blunt tariffs is like trying to repair a watch with a hammer. I think that is a really great metaphor, just to show you how silly of an idea that is. What the November data really shows is volatility. It shows volatility. That 94% increase is volatility, and I will explain in a second why. It certainly does not show that the US economy is about to collapse. Now, back in April of 2025, when the White House declared a national emergency over the trade deficit and announced the so-called reciprocal tariffs, that Rose Garden party, the deficit itself was used as the justification for that. But as the year went on, reality forced adjustments. The framework agreement with the European Union in August capped tariffs at 14% on most goods, not because deficits disappeared, but because what? Instability was becoming just too much. It was too costly. The November surge is the delayed echo of those decisions working their way through the system. That's all there is in a nutshell. So at this point, you might ask, well, if the trade deficit is not the villain that it's made out to be, what's the real issue here? The real questions are they're based on domestic issues, I would say. Those questions are capital inflows being used productively, or are they inflating asset bubbles? That would be the first question to ask. And if you have been regularly watching my videos, then you already know the answer to that question. The next question to ask would be, are tariff-driven price increases hurting consumers more than they help producers? Also, I answered that question just last week in a recent video. Are supply chains being diversified enough, or are they just being made expensive? And economist Michael Hudson answered that question in a recent interview that I uploaded last week. Another question that would be relevant is, are we strengthening long-term industrial capacity, or are we just reshuffling trade flows on paper? And I would argue it's the latter. So those questions matter far more than whether a monthly deficit print goes up or down. That 94% increase should not be taken out of context. The obsession with the headline number misses the point. Trade balances don't tell you who's winning or who's losing. They tell you how money, how goods, and capital are moving through a global system that does not bend easily to political narratives. November's nearly doubled deficit isn't a failure of America. It is a reminder that tariffs don't override economic gravity, and whoever wants to impose a very rigid protectionist regime should account for the real economic data. And tariffs actually redirect that process, even in ways that are harder to control and that are more expensive than advertised in the very beginning. And until the reality is acknowledged, the trade deficit will keep surprising people who think that it is supposed to behave like a scoreboard. Thank you very much for watching. I hope that this quick video was interesting, and I hope that you learned something from it. Make sure that you support my work if you like this content. I appreciate every single one of you who has become a paid subscriber. Thank you so much. And I look forward to seeing you all here tomorrow. Take care.